Have you ever thought what the secret is to becoming a millionaire? It's not just luck or hard work, it's something deeper. A hidden code that only a select few have cracked. Picture this. You could be consistently beating the market, turning small investments into massive gains, just like the pros. In this eye-opening video, we'll reveal 7 secrets millionaires use to crush the stock market. These strategies are not widely known and used by most successful millionaires like Warren Buffett, but mastering them could be the key to unlocking your ultimate financial freedom as well. So if you're ready to take your investing game to the next level, stay tuned until the end of the video. Starting at number 7, consistency over complexity. Millionaires don't get to where they are by chasing wild stock market trends or hoping for overnight success. It's much simpler than that. And Warren Buffett is a living proof. He's built an empire worth over $110 billion, not just by hitting home runs on obscure stocks, but by making smart, steady decisions. His approach is just to do the basics well. And it doesn't take a genius-level intellect or insider secrets. Buffett himself has said, it is not necessary to do extraordinary things to get extraordinary results. What does that really mean? Essentially, you don't need to be a rocket scientist to win at investing. It's not about making high-risk bets or having the IQ of a genius. Instead, it's about patience and sticking to a sound plan. For Buffett, that means finding solid businesses with competitive advantages, buying them at a fair price, and holding on to them. Simple, right? It's a far cry from the idea that stock market millionaires constantly juggle risky investments. Number 6. Don't sweat the percentage returns. Focusing solely on percentage returns can be misleading when it comes to trading and investing. While a 100% return sounds impressive, it's not always the full story. For instance, a novice trader who doubles their initial $300 might celebrate a 100% gain, but that doesn't necessarily reflect a well-thought-out strategy. Conversely, a seasoned investor who follows a disciplined approach might achieve the same percentage gain but with a systematic plan that ensures consistent success. The truth is that percentage returns can be relative and often don't paint the whole picture. They depend on various factors and can fluctuate significantly from month to month, especially in volatile markets. It means a high percentage return doesn't always equate to effective or sustainable trading practices. For professional traders and investors, the focus isn't on the percentage, but on the overall risk-to-reward ratio. This ratio is crucial because it assesses how much risk was taken compared to the reward gained. Number 5. Approach stocks like a basement bargain. When it comes to investing, treating stocks like a basement bargain can lead to impressive returns. Just as you would hunt for the best price on a vintage record or a rare piece of furniture, you should approach stocks with the same meticulousness. The goal is to get the best possible deal even if you're dealing with high-quality companies. When you find a great deal at a garage sale, you don't just grab it and pay the first price. You negotiate, compare, and ensure that you're not overpaying. The same principle applies to stocks. Even if you're buying shares in a solid company, you should be vigilant about the price you're paying. Look for stocks that are undervalued compared to their intrinsic worth. It means doing your homework to understand the company's financial health and market position to ensure you're getting a good deal. Additionally, being a penny pincher doesn't stop at just the price of stock. It also involves minimizing brokerage costs and other fees associated with buying and selling. High transaction costs can erode your profits, so finding a broker with low fees and avoiding unnecessary trades can make a big difference. Every penny saved in fees is more money that stays invested and compounds over time. Number 4. Don't keep predicting the market. The secret to crushing the stock market isn't about predicting every dip or jump. It's about playing the long game and avoiding market timing altogether. Stock market millionaires know that trying to guess the right moment to buy or sell is a losing battle. They focus on patience and conviction, sticking with their investments through thick and thin. Instead of panicking during downturns, they stay the course, confident that the market will eventually bounce back. The truth is, more money is lost when investors try to time the market than in the actual downturns themselves. The real winners are the ones who hold steady, knowing that ups and downs are just part of the journey. Peter Lynch is a prime example of this. While managing the Magellan Fund at Fidelity from 1977 to 1990, he pulled off an incredible 29.2% annual return, more than doubling the performance of the S&P 500. By the time he retired at 46, his net worth was sitting at around $450 million. But here's the thing. Lynch didn't achieve that by perfectly timing his entries and exits. He was first to admit that his fund experienced 9 significant market declines during his time at the helm. "I had a perfect record," he once joked. "All 9 times my fund went down." But Lynch never panicked. He didn't jump ship at the first sign of trouble or try to predict the next crash. Instead, he stayed invested, trusting that the market would recover. His philosophy was simple. Invest in what you know and only buy stocks you're willing to hold through all market conditions. He understood that downturns are inevitable, but he also knew they didn't last forever. Number 3. Invest in quality businesses and diversify risk. The sharpest investors know that it's not just about buying stocks. It's about investing in solid, high-quality businesses. This approach goes beyond simply picking shares. It involves digging deep into a company's fundamentals to ensure you're backing a robust, well-managed enterprise. Understanding the intricacies of a business from its competitive edge to its financial health is crucial. It's like being a detective who investigates every detail before making a commitment. However, even the most discerning investors like Warren Buffett, George Soros, Peter Lynch recognize that diversifying risk is just as important as picking the right businesses. Concentrating all your investments in a single stock or sector can be risky. Even the best companies can face unforeseen challenges, so spreading investments across various assets help protect against potential downturns. Diversification isn't just about throwing your money into a bunch of random investments. It's more like creating a balanced mix. Instead of putting all your eggs in one basket, you spread your investments across different areas, like various industries and types of assets. This way, if one investment doesn't do well, it won't ruin your entire portfolio. Think of it like packing for a trip. You wouldn't pack just shorts or just warm clothes, right? You'd bring a mix to be prepared for any kind of weather. Diversifying your investments is the same idea. By spreading your money around, you're less likely to lose big if one of your investments doesn't perform well. Number 2. The secret. Beware of the impact of a single bad decision. In investing, a single bad decision can significantly derail your performance. It holds true not just for small-time investors, but also for the biggest names in the industry. Even seasoned pros can lose a substantial portion of their gains with just a few poor trades. The market has a knack for catching people off guard, and no amount of expertise or resources can completely shield you from its unpredictability. When you're starting, this risk is even more pronounced. Small investors often have a less margin for error, so a single misstep can disproportionately impact their overall performance. But the stakes are high for large investors too. Top investors have watched their substantial gains evaporate due to several bad decisions. Number 1. Focus on valuation. When it comes to making big bucks in the stock market, the secret isn't just in picking great companies. It's about focusing on valuation and buying when the market takes a dive. Shelby Davis, though perhaps less famous than Warren Buffett or Peter Lynch, is a prime example of how this strategy can lead to impressive success. Davis's story is quite remarkable. He didn't get into the stock market until he was 38 years old, which is a late start compared to many legendary investors. Yet, He turned a $50,000 investment in 1947 into a $900 million portfolio by passing away in 1994. His money compounded at an astounding 23% annually over those 47 years. How did he do it? By focusing on valuation and using market downturns as opportunities rather than setbacks. Davis understood that bear markets and recessions, while challenging, present golden opportunities to buy stocks at bargain prices. He famously said, "You make most of your money in a bear market, you just don't realize it at the time." To him, a market decline wasn't a reason to panic, but a chance to pick up great companies at a discount. His strategy was also grounded in the importance of valuation. Davis believed that no business is attractive at any price. In other words, no matter how great a company is, it's not a good deal if you're paying too much for its stock. This approach is easy to understand if you think about it in everyday terms. Would you buy a car or a house without considering its price? Of course not. The same logic applies to investing in stocks. Ready to take the next step on your millionaire journey? Make sure to hit that subscribe button, because each video we share could be the one that changes your financial future. Don't miss out. Your wealth building starts right now. See you in the next video.